The CNBC Fed Survey does see higher stock prices and higher yields in the months ahead and the years ahead. Let's take a look. What you see is that when we look at the past surveys, we've been going down. Our 38 respondents, fund managers, economists, strategists, have reduced their outlook for the S&P 500 over the course of this year. And now, finally, for the first time in several months, they're becoming a bit more bullish. Not crazy bullish, 2% more left for this year on the S&P and 6% by the end of 2019. And this happens, as you'll see in the next screen, in an environment of rising yields. Right now, we'll call it 298, 3% right now, rising to 323, call it 3.25, and 3.5 by the end of 2019. So in any event, good for stocks to defy that rising rate of drag on stocks. Now, here's the outlook for today or tomorrow's meeting: 100% chance of a rate hike, 81% chance in September. And now it gets interesting here. How many hikes this year? 3.5. That half tells you that about half of our respondents are saying 3 and half are saying 4. Same disagreement over how many hikes in 2019. 2.6 tells you that some are looking for 3 and some are looking for 2. But a bigger question: will the Fed raise rates above neutral? That is, will they raise rates to the point to try to actually slow the economy? And 2/3 of our respondents do expect that. 62% know, 32%, and don't know, 5%. And so that's an interesting idea, guys. The terminal rate average for this group is 3.3%. So that suggests that maybe an additional quarter or maybe a half a point beyond neutral is the expectation of the market here.
Steve, an expectation of 2 to 3 rate hikes next year, that seems to me that implies that maybe economic growth could slow down, according to folks that responded to the survey. What's the take there?
Well, so the take is that they're seeing 3% growth. That's not a crazy funds rate to be more or less in line with the growth rate of the economy, or the real growth rate of the economy. So it's very much along the Paul Tudor Jones idea, which is you're going to have higher yields to reflect better economic growth and better stock prices. So the danger for the market, Morgan, here is if you get the rate hikes, if you have inflation but don't have the growth. If the growth offsets that, you get the earnings, and so a quarter or a half a point more on the funds rate doesn't matter all that much.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.